Multifamily is the darling product type of commercial real estate, and especially with everything going on in the economy right now, many investors and researchers are saying that multifamily is one of the safest product types to be in today. So at the end of the day, what is all the hype about, and why have people been so successful in multifamily in the past decade? That's what we're going to talk about in today's video. Hey, I'm Justin from breakintocre.com, and if you're new here on this channel, we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the industry or you're looking to do your first commercial real estate investment deal, make sure to subscribe and hit the notification bell. Okay, so spoiler alert here, if you don't like math, you're probably not gonna like this video. Because what we're going to do in this video is take some data, put it in a model, and figure out why everyone loves multifamily so much today. And with big names in the space raising hundreds of millions or billions of dollars to invest in multifamily properties, that begs the question, why is everyone so excited about investing in multifamily deals? Now, you've probably heard the basic argument that everyone needs a place to live, and I agree with that, but if you've been watching this channel for any amount of time, you know that I'm a numbers guy and I want to make sure that the numbers make sense. So what are the numbers behind why multifamily investors have been so successful over the past decade? Well, to figure this out, I did some digging through Zillow research data and found historical rent statistics all the way back to December of 2010. And because Zillow has rent statistics on a monthly basis all the way back to 2010, what I was able to do is pull the average rents back in 2010 versus the average rents today across the US and in certain major US cities. Now, I wanted to make sure I had an exact number of years here, so I went all the way back to December of 2010 and pulled that 2010 data as well as data from December 2019 to get a full 9 years in my analysis. And what I found was that for the US as a whole, apartment rents rose from $1,118 in December of 2010 up to $1,483 in December of 2019. Now, over a 9-year period, this represents a compound annual growth rate of 3.19%. This means that on average, apartment rents rose 3.19% over the last 9 years, which is a pretty solid growth rate if you're an apartment owner. Now, this is strong across the US, but if you start to look at some of the most popular US cities for multifamily investment over the last 10 years, you start to see some staggering numbers. In fact, cities like Portland, Oregon, Orlando, Florida, and Denver, Colorado saw over 6% increases, and cities like Atlanta, Georgia, and Nashville, Tennessee saw over 5% compound annual growth rates over this 9-year period. Now, during this same time, I wasn't just concerned with how rental revenue was going to change, I also wanted to know how expenses changed over time. And in commercial real estate, many expenses are directly related to the Consumer Price Index, or CPI. So if we take a look at the data from the US Bureau of Labor Statistics, we see that the CPI in the US in December of 2010 was 219.179, and this value grew to 256.974 in December of 2019, which means that the CPI grew at a compound annual growth rate of 1.78% during this time period. So now that I know my rent growth data and I also know my expense growth data, essentially what I wanted to do was create a sample multifamily acquisition and see how that would have played out over the last 9 years, taking into account a few main assumptions. So the first thing that I did was added an expense ratio. Now, usually what I see for multifamily properties is somewhere between 30 and 40%, but for this analysis, I wanted to make sure that I was conservative, so I set this to the higher end of that range at 40%. From there, I had to assume a purchase price for the property, so I set the purchase price at $1 million for the purposes of this analysis. Now, from here, what I needed to do was make an assumption about what that going-in cap rate would have been back in December of 2010 if a buyer were to buy that $1 million apartment building at that time. So to do that, I dug up the 2010 National Investor Survey report done by CBRE and found that the average Class B apartment building at that time was trading for a 7.18% cap rate. So with that, for a $1 million acquisition, that property would generate $71,800 in net operating income in that first year of ownership. Now from here, I didn't want to only know my cap rate when I would buy the property, but I also wanted to know what I should assume for that exit cap rate at the end of 2019. So what I did was went back to another CBRE research report, this time the CBRE North America Cap Rate Survey for the second half of 2019, and I found that cap rates for all infill properties averaged 5.11%, while all suburban properties averaged 5.37%, so I assumed a midpoint of 5.24% for an exit cap rate on my hypothetical deal scenario. So now that I had all of my purchase and sale metrics, the next thing that I wanted to do is add debt onto the property because most commercial real estate assets are purchased with debt. So to do this, I started off with a relatively standard 65% loan to value ratio and 30 years of amortization. But then I wanted to check back in December of 2010, what would my interest rate be for a 10-year fixed rate loan? So to figure this out, I went back through historical data on the US Department of the Treasury website, which tracks daily Treasury yields as far back as 1990. And if I check back on December 31st, 2010, I see the 10-year Treasury was sitting at 3.30%, which would be my interest rate index for my loan. From there, I added what I think is a pretty conservative spread of 175 basis points to bring my total interest rate on the loan to 5.05% on the $650,000 loan. And now from here, this is where the real math begins. So in this scenario, I assume I buy a multifamily property for $1 million with a $650,000 loan, meaning that I invested roughly $365,000 into the deal after accounting for closing costs. Now, I'm assuming that I bought this property on the last day of December in 2010, and I sold this property at the last day of December in 2019. And at the end of that 9-year period, I will have paid down $105,524 of my principal, and my ending loan balance will be $544,476. And if I assume a 5.24% exit cap on the next buyer's year one net operating income, I'll get $1,958,286 in sale proceeds, and after cost of sale and my loan payoff, I'll get a little over $1.35 million in net sale proceeds. Now here's the really interesting part. If I run my return metrics over this 9-year period, here's what I get. My IRR is 22.3%, my average cash on cash return is 11.67%, and my equity multiple is a massive 4.76x. And these are incredible numbers using rent growth across the US, but if I look at the numbers for some of the most popular multifamily locations, the numbers get even better. For example, with the rent growth of Orlando, we'd see a whopping 30.67% IRR, a 17.69% average cash on cash, and an equity multiple of 8.25x. Now these numbers are massive, and if anyone underwrote these types of numbers today, they'd probably get laughed out of the room by their investors. And the craziest part is this isn't even factoring in things like renovations, which could add a 10 to 20% increase in your revenue in those first 1 to 2 years. So with all of that said and that analysis done, what does this analysis tell us? Well, US apartment investors have been extremely fortunate in the last decade. And even for investors that haven't done much to their properties, they've seen significant value growth just through rent growth and cap rate compression. But with that all said, what can we take from this analysis that's going to help us invest more wisely in the future? Well, today, with interest rates at all-time lows and cap rates at lows as well, it's tough to believe that cap rates are going to continue to drop over the next 10 years. But with the 10-year Treasury as low as it is today, assuming cap rates rise slightly, even assuming a 2.25% spread for an all-in interest rate of 4.17%, and cap rates rise 100 basis points from 5.24% to 6.24% in 9 years, investors would see an IRR of 11.19%, an average cash-on-cash return of 6.52%, and an equity multiple of 2.32x. Now with $1 trillion plus stimulus package potentially on the horizon for the US, we could see some major inflation numbers coming along over the next few years, which could increase that CPI substantially from that 1.78% number, but generally rents will also increase with inflation, so we're not likely to see a huge difference in multifamily expense ratios going forward over the next decade. So the bottom line is we may not see the massive returns that we saw in multifamily in the next decade going forward, but we're still likely to see strong returns for people who buy multifamily and hold long term. So I hope that was helpful if you're thinking about investing in multifamily and trying to understand the numbers behind why these deals are working. Now, if you want to learn how to do an analysis like this, make sure to check out Break Into CRE Academy, and I'll link that in the description below. That's going to teach you all you need to know about Excel in real estate finance and financial analysis. And if you want a free crash course on real estate financial modeling, I'll also link that in the description as well. So thanks so much for going down this rabbit hole with me. If you like this video and want to see more videos like this, make sure to let me know by hitting the like button, subscribe to the channel, and share this with anyone else who might find this helpful. Thanks so much for watching, and I'll see you in the next video.